As the current year is coming to a close, it's never been a better time to either load up on some high quality ETFs or even start a brand new ETF portfolio made with only high quality names. Now in this video, we are going to go over 3 of the best dividend growth ETFs in my opinion, and also explain exactly how these ETFs work and what they have to offer. Now make sure to stick around, drop a like down below and subscribe, and let's get started. Now the first super high quality dividend growth ETF that you should definitely look into adding to your portfolio or even starting a brand new portfolio before the end of the year while it's still on sale in my opinion is ticker symbol VIG, or the Vanguard Dividend Appreciation ETF. Now this Vanguard ETF is super high quality in my opinion, and the product summary is as follows. It says seeks to track the performance of the S&P US Dividend Grower Index, its passively managed full replication approach, remains fully invested, and invests into large cap equities, emphasizing stocks with a record of growing their dividends year over year. So in case you're maybe newer to dividend growth investing, dividend growth rate is one of the most important metrics of all, but we're going to dig a little bit more into that in a minute here. So as of filming this video, the Vanguard Dividend Appreciation Index Fund is basically flat year to date, up 1.5%, and is trading pretty close to the middle range of the 52-week range. But if we zoom out to the max time frame, this ETF has performed insanely well over the long term, up 209%, and that's not even including dividends. Also important to note, VIG has an expense ratio of just 0.06% because it is passively managed, and this means that it's not really going to cut into your profits too bad. As far as assets under management, VIG is a massive ETF with 66.17 billion in AUM. Now, one of the main reasons I'm a big fan of VIG is the fact that the holding breakdowns are as follow. Technology at almost 23%, financials at 18%, healthcare at 15%, industrials at 13%, consumer defensive at 12%, consumer cyclical at 7%, basic material at 4%, energy at 3%, utilities at 2%, and communication at 1%. Now this holding breakdown is honestly pretty close to perfect if you ask me. There's a nice amount of technology being the leader as far as the holding breakdown, but at the same time there's not too much technology, which means this ETF is going to have a little bit more of a considerable beta. Now the top 10 holdings of VIG are also very, very good. We have Microsoft being the leader, then Apple, ExxonMobil, United Health Group, JP Morgan, Johnson & Johnson, Visa, Broadcom, Procter & Gamble, and MasterCard. All in all, around 318 different holdings make up this ETF. This ETF is all around very, very high quality. But now to talk a little bit more about the dividend and the dividend growth that VIG has experienced. So the current dividend yield that VIG is offering is around 2.03% more or less, which isn't all that great considering that's probably not going to generate any meaningful cash flow right off the bat. But that being said, with a trailing 12-month dividend growth rate of almost 10% and a 3-year of 12%, a 5-year of 9.5%, and a 10-year of 7.8%, dividend growth is definitely apparent in this ETF, which means that even if you are getting a starting dividend yield of around 2%, let's say, over time you are likely going to get paid more and more if you invest into something like VIG. At least that's what it has done historically. Now, dividend growth is a really important metric to me because I want to live off the cash flow from my dividend ETFs and from my dividend stocks in the future. And with a vehicle like VIG, you are definitely most likely going to be able to do so. The next absolute monster of a dividend growth ETF that you should definitely look into, invest into before the end of the year is none other than the Schwab US Dividend Equity ETF, or SCHD, and I'm sure you already know a lot about this one. The fund's objective is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. And as of filming this video, SCHD is down quite a bit, down over 7% year to date, which in my humble opinion makes this a great buying opportunity for a long-term investor that wants to lock in a great starting dividend yield, because as you're going to see here in a second, it is offering quite a bit. Now some more facts about SCHD. The fund is up 169% as far as all time, and that's not including dividends, which is also very, very impressive. It is on a major dip right now, trading closer to the lower end of the 52-week range at around $69, $70 as of right now. The expense ratio is also 0.06% because it's passively managed. The assets under management are less than that of VIG at 47.58 billion, but just like VIG, SCHD is very, very popular. Now looking at the holding breakdown, SCHD is also very diversified with 17% as of right now being in industrials, 16% being healthcare, 15% financials, consumer defensive is 12%, technology is only 11.6% in this one, energy 10%, consumer cyclical 9%, communications is 4%, basic materials 1%, and a little bit of utilities, government, and cash. Now, the top 10 holdings are definitely the culprit on why SCHD has performed so horrible year to date. Companies like Amgen, abbvie, Chevron, Merck, Pepsi, Broadcom, Verizon, Coca-Cola, Texas Instrument, Cisco, and others. SCHD does have a basket of around 100 different holdings, and like I said a second ago, because a lot of these top holdings, as of right now, have been performing pretty horribly. Take abbvie, for example, down almost 9% year to date. SCHD is offering a massive potential opportunity for investors that have a long time horizon, in my opinion. Now, some more information on the dividend. SCHD has a 3.7% trailing 12-month dividend yield, which I think for this sort of ETF is very, very considerably high. But also, just like VIG, SCHD has some nice high quality dividend growth. 5.7% year to date, 11.4% over the 3 years, 13.69% over the 5 years, and 11.11% over the 10. So of course, we don't know what's going to happen in the future, but historically speaking, a few things are for certain. SCHD has considerably paid more and more in dividends as the years have went on, and it's traded pretty good overall. Now, that being said, like any ETF, it's going to depend on how the stocks within the index that the ETF tracks perform over the next, say, 5-10 years to see what the future holds. But for me personally, I've been buying shares like crazy of SCHD during Q3 of 2023, and I will continue to do so. Now, the last dividend growth ETF that I think could be an awesome opportunity to grab some shares of, or at least to look into before the end of the year, is ticker symbol DGRW, or the WisdomTree US Quality Dividend Growth Fund. Now, this fund says that they seek to track the investment results of dividend-paying large-cap companies with growth characteristics in the US equity markets. Now, year to date, DGRW is actually up 4.71%, which is considerably higher than that of SCHD, for example. Now, this ETF does have a pretty pricey expense ratio of 0.28% and does have almost $10 billion of assets under management. On the max time frame, this ETF is up around 156%, pretty much matching very closely the returns of that of SCHD. Now, right away, you're going to notice that this ETF has a majority of the holdings in technology, which is again why I like this ETF. Because I am a relatively younger investor, I do want to have some potential exposure to things like technology because they are going to give you a little bit more growth potential and more upside potential than some of the other industries. But technologies makes up almost 30%, then consumer defensive at 16%, industrials at 14%, healthcare at 13%, financials at 12%, consumer cyclical at 9.4%, basic material, real estate, energy, and utilities and communication are all around 1 or below percent. Now, the top 10 holdings are really high quality companies also, like Microsoft, Apple, Broadcom, Johnson & Johnson, Procter & Gamble, The Home Depot, Merck, Cisco, Coca-Cola, and Walmart. Around 300 holdings within this ETF. And honestly, even though I don't hold any DGRW as of right now in my portfolio, this is probably going to be a holding of mine very soon. And I think long term, it could potentially even be the largest out of all of them. Now, to look a little bit deeper into DGRW's dividend and the dividend growth, DGRW has around a 1.92% dividend yield as of right now, trailing 12 months. The dividend growth rate on the 3 year is 7.4, the 5 years is 7.17, and the 10 years is 23.16. Now, DGRW does pay a monthly dividend, and the amounts are sort of all over the place. It does have sort of a cadence involved, but that's why the dividend growth rate is sort of confusing. So there we have it. Those are 3 different high-quality dividend growth ETFs that all have a few things in common. They all have a track record of nice growth performance. They all have a nice basket of holdings. They all pay a fair, decent starting dividend yield to ensure cash flow right off the bat, but also have massive dividend growth historically. Now, out of all 3 of these different dividend growth ETFs, if you could only hold on to one throughout the entire year of 2024, which ETF would it be and why? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more feature content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.